The last 4 years have tested everyone. Massive drop in values, interest rate rises, inflation burning a hole in your pocket, and general uncertainty for all. But property's always been a long game. The short term feels chaotic, yet the fundamentals never really change. While most people have been waiting for the right time, a smaller group quietly keeps moving. They buy well, add value, and position themselves for the next cycle. Today, I'm co-hosting with New Zealand's #1 award-winning financial advisor, Zhiyang Cheng. Today, we'll unpack what's actually happening over the past few years and what smart investors have been doing behind the scenes, and where things could be headed next. Don't miss out.
It's been one of the toughest 4-year stretches we've seen. Interest rates more than doubled from 2022 to 2023, which meant borrowing power dropped 30 to 40% for most people. Inflation affected the cost of living, cumulatively 15 to 25%. Prices plummeted 10 to 20% across the country, forcing confidence to collapse through the floor. Construction hit pause, listings built up, buyers froze. It felt like the whole market stopped moving. But at the same time, net migration started climbing again. So even though demand softened, supply got tighter. With 8 interest rate drops since July 2023 and an unexpected 0.5 cut this October, the winds of change are starting to build. The fundamentals never disappeared. People still need homes. That hasn't changed. And now, for the first time in almost half a decade, we are starting to see the light at the end of the tunnel. And that stability is what rebuilds confidence in the market.
Great. Let's unpack some smart strategies that our investors, yourself, and others have implemented during this downturn. How about first up, let's discuss one of the properties you purchased, right? I was with you when this happened, and interest rates were at its peak.
That's right.
Tell me, where did you go when, the brown stuff started hitting the fan?
So yeah, during the absolute peak of the interest rate environment, it was sitting at 6.85%, I believe. I decided to purchase in Gisborne.
Good old Gizzy. And why did you go there?
Yeah, I guess Gisborne had some decent fundamentals that we were looking for. The yields were very high, property prices were still relatively low, and the rents were, relatively high.
Right. Well, why was the yield important?
Yeah, so I'd say yield is important for everyone, not just for me. But in particular, for me at the time, my portfolio was very, very skewed towards, in the Auckland market. So what that meant was my average gross yield across my portfolio was relatively low. So I needed to rebalance that and buy something in the regions to increase that.
Mm. And did you sacrifice on maybe an equity gain when you purchased it as well? Like, usually get high yields, you're not really getting that equity. Did you manage to do something like that in this deal?
Yeah, that's correct. I mean, that's the general idea. But in this case, we built some instant equity in the purchase. So buying below market value.
Okay, great. And what gave you the ability to position yourself to actually purchase a property like that in the first place? Was it a negotiation technique or preparation? Tell me a little bit about that.
Yeah, I guess, I already had a few properties in Gisborne at the time, so I somewhat knew what the market was doing. The property came up in December, so everyone was, getting ready for the Christmas break and the holidays, but I noticed that there was a good property popped up. So it was an auction, so no negotiation involved. Basically, you're going in with, you're preparing with your best price, and, lucky for me that the highest price, I was the only bidder, and we got it for a lot lower than what I was prepared to pay for it.
I guess that was the market, right? Like, everyone was running scared. So what gave you the confidence to actually turn up on auction day and bid?
Yeah, it's a great question. I guess for me, the numbers worked. So even when the rates were at 6.85%, I did my numbers, and I knew that if I were to buy it in this current climate, it would be cash flow neutral. So if the rates ever did move down, it'd be positive. So that's what gave me the confidence to move ahead at the time.
And why did you still have such confidence in the property market? Right, everyone was running scared away from property, saying it's doomed forever. You were there, you thought, okay, undervalue, cash flow neutral, but why property at all?
Yeah, I guess with property, the key advantage that we have is that, we've got the power of leverage. So, it's not like I had to save some money to invest into an asset, right? We had equity in our properties, so, why not put that to use? So it wasn't a matter of like us earning money, paying tax on it, then investing it. With property, we just go to the bank and ask for the amount, and we get to purchase the property.
Because it was 100% financed, right?
Yeah, like most of our clients do that as well. Yeah, 100% finance. Yeah.
And let's break down these numbers one by one. I want to know the details. I want to know the address. I want to know the yield, the purchase price. So if you can go through that one by one for us,
Cool.
That would be appreciated.
Great. Cool. So the address, 22 Miro Street, Elgin. Purchase price, $275,000. Renovation cost, $35,000. So all up, $310,000. Rent per week, $650. The valuation now is $475,000. The yield on cost at the time, 11%. So over 150K of equity gain as per the online valuation. Cool. Enough about me. I want to hear about some of your wins and your clients, Simon. Tell me about what you did for the client we spoke about recently, the one we had a big win on.
Yeah, it's a real privilege to work with people sometimes that come through Mortgage HQ that really listen and take the advice and run with it. In this instance, a client came to me because he was considering selling down a large portion of his property portfolio because he thought he had to. He wanted to buy another owner-occupied home that was more suitable for him and his kids. And so effectively what we did is we moved $1 million from non-deductible debt into deductible debt.
What does that actually mean? Like, how much do you save the client from moving a loan from a non-deductible debt to deductible? How much do you save?
At the time, it was about $20,000 a year. So it's quite significant. And the other added advantage is the client didn't actually need to sell down part of his portfolio while we're still in this downturn.
Okay. So that's the implication. You don't need to sell down the portfolio. He gets to keep everything and ride the wave until it picks up again. Nice. And who did you have to collaborate with to get this done?
Yeah, it is important to note that to be able to deliver something like this, you do need to be able to have strong referral networks and partners, professionals in accounting and legal, and that's the main people I spoke with, his trusted team, to ensure that the T's were crossed and the I's were dotted. Like I say, it's not just in the scope of what we provide. So I gave him the idea. We wrote up a summary from a lending perspective, what the bank could do and the correct entities. And then he went and spoke to his accountant and lawyer with a much more summarized version of what he may have gone there with a whole lot of questions, reducing the cost, increasing the speed of the application, and a much better outcome for the client.
Nice. So yeah, that sounds like what a good advisor can do for you, for clients. We can pull professionals together and identify opportunities for clients. Yeah.
That's right.
Cool. Yeah. Cool. Let's deep dive into some core investment fundamentals, the ones that we stand by and the ones we consistently see our clients succeed with.
Yeah, I think the first one is the one that comes to mind for me, especially given what's been happening in the market with interest rates, is that no matter where interest rates are going, up, down, it shouldn't really change the fundamentals of the property purchase, right? It's just a factor that you put into your spreadsheets to make sure that there's still cash flow,
Yes.
or at least neutral, and you've got a one or two exit strategies with a long-term plan for property. That's one of the biggest fundamentals I have.
Yeah. Nice. And obviously you can't control the market, right? You can't control where prices go, whether they rise or fall. But what you can control is your entry point. And that's the biggest difference with property and other asset classes, right? You decide where you enter.
Yeah, much more control. Obviously you can purchase shares at a low and sell at a high. Warren Buffett. But with property, it's much more controllable, especially for the little guy, right? It's all well and good. Warren Buffett, with all his leverage, can review the financials of large businesses and do analysis on them. It's much easier for our clients that we work with to do that for, say, a property in Gisborne, Auckland, Hamilton, that kind of thing. So it really does allow them to buy below market value, which gives them that safety of margin safety. Safety margin. And for people that don't understand what safety margins are,
Margin of safety.
Do you want to give us a bit of a breakdown on that?
Yeah, it's really just a built-in buffer for the unexpected, right? So if a property is worth $1 million and you purchase it at $900,000, if the market drops 10%, then you haven't lost any money. That's really what it is.
Nice. So you're hedging your bets, so to speak, in uncertainty. If you still have that drop, you've not lost the value.
Correct.
So combining a couple of these things together can really give you that competitive edge when purchasing property. And what I've seen also is that investment vehicles are becoming harder and harder for the small guy. And so property is one of those areas that I find is still available for them. You have the likes of big mega corporations buying up property, but in a lot of cases it's commercial or larger property bases. And so the margin can still be there from a percentage perspective, but the money gained overall on the project isn't enough for these big guys. So they leave a lot of money on the table for us to come and scoop up, right?
So can you tell me what that means? Like how do you scoop that money up?
I think the biggest thing is, the difference between the ability for a small guy to go and do that rather than a big competitor is, like I say, the amount you can actually gain there. It's going to put off larger investors or corporations. And so the little guy can go in there and make 20, 30, 50, 100K and make a real significant difference in their lives, but it's not going to make any difference and not going to make someone sitting at the top of a tower in central Auckland happy, right? Or a business.
So what are some strategies that these guys are doing? These small guys, as you mentioned.
Yeah, I think it's, really looking at the specifics of the property. It's all well and good looking on Trade Me and putting some data together to scrape some of this information, but it's going there and finding out actually it wasn't advertised the best way. The marketing on Trade Me didn't mention this upside, right? And so by going there, seeing it, you get that leverage that you can actually purchase it for what people may see as current value, but you're actually purchasing it under value. And when you go to remarket it in the future or gain more rent from it, you can hold it for much longer as well with a good yield. So it's really about the micro, right? Going in there, finding the specific deals and negotiating. So you might look on Trade Me and something's listed on there for 800,000 and it's been sitting there for a long time, and you get some sort of leverage to figure out that actually the person would accept much lower, that the agent was trying to get a lot higher, that there are things wrong with the property that you make them aware of, that you can fix for a certain price, and they may think it's going to cost them a lot more or be more of a headache, and time is a lot of things as
Yep.
well. And so if you can leverage all those things, you can get property for a really good deal. And that's what I mean by the micro.
Nice. We call it the arbitrage, right?
Yeah.
Nice. So I guess what we're saying is, focus on what you can control, right? Ignore the noise, and letting time and good decisions do the heavy lifting for us, rather than trying to time the market. Yeah.
Yeah, and I guess that's one of we see a lot of our investors and friends and family do flips, right? And it's not really something that we're focused on. It's not something we're big on at Mortgage HQ either, although we do have people making a lot of money in that space. If we're thinking about how we position ourselves and how we promote to a lot of our clients, as we're going for those multi-units that aren't for first home buyers. We're not buying first home buyer properties, renovating them and flipping them. We're adding massive amounts of value on like a triplex or a duplex. We are developing properties, adding to the property stock, right? And holding on to them for long term, right? Long-term investors, and that's where you get the ability to reduce your risk, and you get, when the market starts to turn, you get those real gains over time. We've done some research and we've come together and looked at a couple of cases, the case for a bull run, a case for a bear market, right? And so we've got a couple of points here. You go through the bull cases, I'll go through the bear, and then we'll see where we end up and where we think the economy in New Zealand and the wider New Zealand property market is going to go.
Cool. So, a factor that's going to influence the property market is obviously migration. So the data suggests that over the last 2 years, 2023, we had a net migration of 96,000 people. 2024, 74,000 people. And this year, it's still to come. What does that mean to you, Simon?
Well, net migration is good for the economy, right? But what I would say is that if you turn on the news or you look at what a lot of people are saying, is that a lot of New Zealanders are leaving, right? And that's not a good thing. New Zealand as a whole spends a lot of money on people growing up in New Zealand, supporting them. You've got infrastructure, you've got schooling, you've got dental, you've got, you name it. There's some estimates like $500 to $1 million per person, right? And these people are jumping ship and ready to be in a career and contribute to the economy in New Zealand, and unfortunately go to greener pastures, so to speak, in Australia and elsewhere. So, I'm concerned about that. I'm concerned about what New Zealand is going to look like. But in short, net migration is going to be a good thing. It's going to put pressure on housing stock, and so that's going to put pressure on prices.
Cool.
So there's definitely a bull case, right?
Yep. So second thing is obviously the interest rates. The rates are now reaching its long-term average or getting close to the long-term average. So obviously when rates come down, people have more confidence borrowing money. So I'm not sure if you guys are aware, but when you borrow $1 million at the peak, 6.85%, versus you borrowing $1 million now at 4.49%, you're saving $25,000.
Yeah.
That's roughly $500 a week that you're saving from the peak till now. So it's a lot more you can borrow, or a lot cheaper to borrow the same amount.
We have clients that range from lower than that mortgages all the way up to like 3, 4, 10x that, right? And so you can multiply that with some of the investors that would be purchasing additional investment properties, will be building additional developments. And so you can kind of see and build that case, right? There's actually going to be a lot more cash flow to go towards more debt, And so, I think that's definitely a bull case. And we haven't even seen some of the effects of this latest 0.5% cut. And so it'll be interesting to see what happens in later November. I think there might be a case for another 0.25 cut. It is some time before the next OCR announcement after that. So they might want to say 0.25, wait, see what happens. And it'll be interesting to see what happens over Christmas, summer, people coming back to open homes, that kind of thing. But we'll be see. But I definitely think it's a part of the bull case.
Definitely. And the third thing that we have here is obviously a lot of zoning reforms that have come through. Council is making a lot of changes around the zoning. So what could have been done, what couldn't have been done before in particular parts of the city, you can do a lot more. There's a lot more intensification that can be done. Obviously, alongside that, there is, what we've seen in Auckland in particular, water care. They put a stop to development in a lot of areas where there's, red zone.
Yeah.
So, yeah, there's good and bad.
Yeah, definitely good and bad. Like you say, Watercare has put some stamp on certain areas, red zones, and they're no longer going to be able to develop like they used to. I feel sorry for people in those positions. I mean, you and I do joint ventures and developments, and I would have hate to be in that position. Have a development looking to go towards resource consent, haven't quite got it approved. Sorry, you can't develop the property, so you likely have to liquidate, right?
Yeah.
But on the plus side, the infrastructure wasn't really there, right? And so that probably is a good thing long term for Auckland.
Yeah.
And I guess like you pointed on there with regards to the bull side of things is that there's a lot more intensification where it's actually needed.
Yeah.
Right, around the train stations, bus stations, and the like. So, I'm quite confident that overall that is looking like part of the bull case. So, over to the bear case. It's no secret that affordability and the recent cost of living crisis has really affected people's ability to borrow and purchase property. So, I mean, you must have had clients you've had talks with throughout this period. What's your experience with it?
Yeah, look, the way I see it is, even though rates have come down, a lot of that money is not going towards borrowing more money. It's going towards their living. The cost of living has gone up. So like we said in the beginning of the podcast, there's roughly 15 to 25% increase in cost of living over the last couple of years. So yeah, I'd say, even though there is a light, there is also, we're not out of the woods just yet.
Yeah, I think there needs to be some serious questions about how that we address that. Definitely well and truly above our pay grade. So wage growth, right? This is definitely lagging. It kind of goes hand in hand with affordability. Wage growth lagging, especially in relation to inflation, right? Inflation has been out of the control. And you touched on it at the beginning as well. Cumulatively, it's just been a massive headache for people. So wage growth, definitely we need some people getting some pay rises. So the next thing and final point I've got here is general sentiment, right? I do think there may be some changes coming about. I definitely see more people coming through wanting to start looking at investing that we had spoken to a year or two ago, but on that fence, so to speak. But people haven't really recovered truly from the trauma that they went through. You had people lose their complete deposits, their life savings in this last cycle.
That's right.
So did you have any specific dealings with clients that had experienced something like that?
Yeah, I mean, I've seen lots of scenarios where clients have bought a property for, let's say, $1 million. They put in a $200,000 deposit, right? 20%. Now the values have come down to 800,000 or even less than that. So, they've got more lending than what their property is worth.
Yeah.
It's and it's more prevalent in Wellington. For the most case, but we've seen that in Auckland.
Yeah,
I've certainly lost a lot of money in some of my properties as well, so it's not a secret.
Yeah, you can see the stark difference between people who actually got really good advice in those positions and didn't. I have a client that both their properties went down. They purchased outside of our company a new build in Auckland, and they didn't split bank either. And so now not only are they stuck, the reduction of values of their investment properties has pulled their ability to go forward on their own occupied property in this down market. So they can't capitalize in the downturn. It's a sad position, but we do see that juxtaposed with people who have actually received great advice and have added one or two to their portfolio whilst being in the downturn.
That's right.
So I guess to summarize this section about the economic outlook. We're no economists, right? But we've been in the market for some time. We've seen several cycles, and so I really would like to hear what other people have to think. Like comment in the section below, and let us know what you think. Is it going to be a bear run, or is it a bull for the next 5 to 10 years?
Cool. So I guess what we should look at doing now is figuring out what you should do, like how you should position yourself at the moment in this current market, right? So I've got a few points here. So first of all, everyone should always audit their financial positions and your goals regularly. So why? Because, you may have had a chat with an advisor or your bank a couple of years ago. They said, no, you can't do anything, but things change, like lending policies change, test rates change. So, if you weren't in a position to do it a couple of years ago, you might be surprised. You might be able to go for another property. You might be able to restructure your portfolio. So that's one thing you should do.
I probably have 1 or 2 conversations a week with existing clients that exactly extrapolate to something like that. I don't know if I'm in a position to be able to get a better deal at a different bank and possibly purchase, And then when we go through the cash flow possibilities outside of Auckland or Wellington, they actually see that they can actually add to their portfolio and do something take some action while in the down market.
Yeah, definitely. Second thing is obviously keep your liquidity. So we're a huge advocate for that. Have big offset facilities, revolving credit facilities. They don't cost you anything, but it means that you've got ammunition. You've got chips on the table to play if you need to pay those chips, right? So
we must have a couple of examples of where that's really important, right? Like, I'll think of one. I have a lot of clients sometimes looking to downsize. Whether it's selling a property or whether it's, rejigging the portfolio where they have some cash proceeds. And sometimes their immediate thought process is to use that cash to pay down the debt, right?
Yeah.
And then I just remember clients that have gone through this where they really needed the cash and the bank at that time was not going to give them a loan.
Yeah.
Right. And so I try my best to convey these stories to my clients so that they are in control if it happens to them.
I mean, you do that for your parents, right?
I did. Yeah. My parents are still working, and their intention is to continue working. But we never know what's going to happen.
Correct.
I've told my mum a million times she needs to retire, but she decides not to. And a lot of people are like that going into retirement as well. But it's about just accepting the realities of certain risks and making sure that the chips are on your side.
Correct. Great. And if you are an investor at the moment, I would say, look for tired listings, properties that might need a bit of a do-up and, potential for value add. Chances are these properties aren't going to be picked up by first-home buyers. It's going to be more so investors, so the pool gets a little bit smaller for the competition. Hard listings and motivated vendors. Like, these are where you find the deals in the market, right? Next thing I would do is definitely rerun the numbers on your existing portfolio and just make sure that your portfolio is fit for your long-term goals. A lot of the times we see a lot of clients with a lot of equity. They're paper rich, but they don't feel like they've got the money. They don't feel like they have the cash flow. And that's quite a unfortunate place to be. And if you've worked so hard in your whole life, you get to your 50s and 60s and suddenly, rates go up, they come down a little bit, you don't have too much to show for it. So what I would say is definitely have a chat with, an advisor just to review your numbers on your portfolio.
I would argue actually that's a low-hanging fruit.
Yeah.
Right? That's actually something that clients can quite easily revamp and redo, right? You don't actually need that much skill to get really good yields in this market.
Yeah.
And so the hard thing that I'm finding with a lot of my clients is that getting them to a position where they can actually build significant equity. But with the clients that have got that equity, they got the ability to desecuritize a couple of properties and swap them out and be flexible and add in some cash flow properties, really dramatically changing their position. It's actually an easier thing than we think, right? We help many of our clients do that.
Yeah. Definitely. And the last thing would be, don't try to pick the bottom. Don't try to wait until sentiment turns around, because by then, a lot of the times, it's already too late. The momentum's already picked up. Then you're fighting, you're battling all the other investors, trying to get the deal.
I would say, like, more specifically there is, it's not like it's too late sometimes when it starts to move in terms of getting some growth. It's more about getting the deal, right? When you start to see the data coming through and the growth coming through, everyone and their dog's going to be at the auction. Everyone's wanting to put an offer down. People put too much down, right? And so to get a deal, you're going to have to be doing it in an environment where everyone thinks it's a bad idea, right? And so I think that's what you mean there as well with regards to not picking the bottom.
Sure.
It's accumulating some assets whilst everyone else is not in the market. Makes it a much easier to negotiate.
That's right.
The last 4 years have been tough, no doubt about it. But they've also taught people to be sharper with their money and clearer about what actually matters. The fundamentals haven't changed, and now that rates are settling and confidence is starting to slowly come back, the people who stayed prepared are going to be the ones who move first. The truth is, most Kiwis aren't great at setting financial goals. But if there's one thing we do really well here at Mortgage HQ, it's helping people find clarity, setting those goals with you, and encouraging you to see them through. So if you've been thinking about your next step, and you just want to check your lending structure and see what's working for you, book a chat with the team today. We'll help you get clear on where you are, what's possible, and how to actually get there. Because sometimes clarity is all you need to start moving again. Book a free strategy session with Mortgage HQ. We'll help you connect your lending structure with your long-term wealth building strategy. Woo!